Okay, welcome everyone. We'll start our second lesson on global finance and strategy. So before starting our second sessions, first, we'll a bit recap what we learned during our last lesson. My name Anjum Sathar. My email addresses are here in case if you need me, please drop me email. If you're listening this recording, so any question about uh, global finance and strategies, anything, just drop me emails on these email addresses. So we'll first recap what we learned during our last lesson. So before moving forward, okay, so we looking during our first lesson, we went through and we understand the concept of globalization. What is meant by the globalization? So the business, when we have uh, more than two countries and many different part of the world, we call globalization. So throughout, like Unilever business in 130 countries, so we call the Unilever have a global presence, globalization. So concept of globalization is fast growing because of course removing the boundaries between countries, the trade agreement between countries, NAFTA, North Free Trade Agreement between America, Canada and Mexico, and EU, European Union, all these toward the globalization. So a bit discussion globalization and localization, some concept due to the vast globalization is impacting the local industries as well. We have to protect the local industry. So we discussed these. Then second learning outcome, we discuss about the factor, what type of the factor those are affecting the globalization. We discuss about the past political, economic, social, and technological factor. We discuss the micro environment and the macro environment, internal and external. So all these discussion was focused during our last lesson, where we discuss about defined globalization, investment process in globalization, foreign direct investment, joint ventures, and mergers and acquisitions. So that's we discuss in learning outcome 1. Learning outcome 2, we'll discuss first. We discuss about the barriers, we discuss about the Porter 5 forces, and these factors we discussed during our last lesson. Today we'll move forward. We'll discuss about the business valuation, how we can evaluate the business different model, strategic implication of mergers and acquisition, when two or more companies work together and merge as a single entity. So we can look around this as a merger. So lot of mergers, acquisitions are fail in the world, but lot of are the successful as well. What is the key thing why the mergers are failure? Because of course every organization have a different culture, different values, and sometimes when you merge as an organization, the key example of in the UK, Morrison take over the store used to be called Saveway. 250 store took in the past 2005-6 Morrison, but Morrison only managed to convert 50 store according to their layout, according to their culture as an organization. So rest of the store they sold to, and even those 50 store, the conversion costs were higher than the acquisition cost. So we need to look around when we acquire, what impact will be on your existing business. So all this very crucial before making the decision of the mergers and acquisition. Maybe it makes loss for your earning making units. Your profit making unit can be really impact due to the merger and acquisition. So today our focus will be learning outcome 3 and learning outcome 4. Strategic, what it mean? It mean the long term. We look the management can play a key role in. So short term, medium term, and long term decision is more generic, which we discussed in the past and the different units as well in this. So under the 1 year, anything decision less than a year is called short term. Medium term is 1 to 3. It depends on the nature of the industry, depends on the nature of the decision. Tactical decision is mean the tactics, technique, or operating decision which we use to run our business successfully, and our business will stay and sustain in the long run. So all this we will be in our discussion today. So we'll move back to our lesson, what we supposed to do, and we'll start our proper session now. So as I mentioned earlier, lesson 2, global finance and strategies. My name Anjum Satar. If any question, drop me email. So LO3, be able to construct strategies that will result in enhancement organization value. So whatever the strategy you're making it, actually your purpose of the strategies is mean to enhance the organization value. If it decrease the organization value, what's the point? What's the point to make a strategy direction plan? We decrease the value of the organization, the worth of organization. So, and then be able to evaluate the financial consequences of strategic decision. So, which will go through some strategic decision. What the consequences? I'll try to quote some examples for you, so which you can embed, and I'll send you some background reading material as well, which I'll try to upload on Moodle and send you. If any question, ask me. So let's, first, different people have explained the word strategies. It derive from originate from Greek word strategist, which is we use the word to how to tackle enemies. So how we can, it's normally used to be in military. So the determination of the long run goal, objective of an enterprise, adoption, course of action. So strategy is a course of action, allocation of resources, necessary for carrying out these goals. So according to Alfred, then next, according to Michael Porter. Michael Porter is a great scholar. He wrote many books, and he's also known as a guru of management. So competitive strategy is about being different. So you as an organization different than your competitor. It means deliberately choosing a different set of activity to deliver a unique mixture value. So that's what we need to look around to make our organization successful. So second, we need to look around, according to Henry Monsberg, a pattern of stream of decision. So that is a strategy. So exploring strategies along direction of organization. So here we're looking, whatever we are looking here in our discussion really will be focused on the exploring strategy that will create or enhance the value of organization. So that's we need to look around. So how we can measure the value of organization, that is quite crucial, because we're looking the financial elements more than, as of course is the everything either in numbers or non-numbers, quantitative or qualitative. We need to be looking around any decision whatever we'll make that will increase the value of the organization. So next we are focus is the value business evaluation. How we can do, why do we need evaluation? A share valuation may be needed for any of the following reasons. So we need to value our company based on, for any shares or the purchase of shares, we need a valuation of the business. As a price for the merger or acquisition, we need a valuation. So that's why the valuation is very, very important. For the tax purposes, capital gain, inherent tax. Anybody knows what is meant by capital gain? The gain is mean the asset you buy and you sell it. That's not your main business to buy and sell assets, but you invested in the building, but actually your business is manufacturing goods and selling goods, but actually some spare cash you have invested in properties, and that property you are selling now, and that's a capital gain is come on the non-current asset. Non-current asset mean which is not as a long-term asset, the asset which we can use many years. Anybody, any question? Inherent tax is a huge, when inherently, like your forefathers, your fathers, your loved ones leave the properties and you have to pay tax on it. It's called inherent tax, because the inherent tax, if they used to live in a house, their house value was 324,000 and above, inherent tax will you have to pay the money. And lot of inherent tax changes happen in the personal tax under the Finance Act 2018. So that's we need to be look around for the tax perspective as well. That's why we need to have valuation for the business as well. For disclosure purposes, the director may given the shares at the price of their remuneration. So we need to look around, the director may be getting the shares in there. So we need to be look around the of those shares as well. For other legal purposes, such as divorce settlement. Divorce settlement mean the company want to be want to be two group merged together. No, they want to be work as a separate company, separate entities, separate organizations. So that these are the purpose can be, we can measure the value of organization. Next are slide, we're looking how to value a business. So there are the three basic ways to value a business. So cash based method, the theoretical premises here is the value of company should be equal to discounted value of the cash flow. Couple of you maybe learn about discounted cash flow method. Discounted cash flow method is we need to look around. That's NPV, net present value, is called investment appraisal method. So those methods we use to be look around this and calculate our value. And when we investing and making decisions, that is why very crucial. So market based method, where we assume that the market is efficient market, everything is running smooth and the company performing, and so use the market information such as the share price, PE is called E ratio, profitability earning ratios, efficiency ratios, so the target companies and other companies, and assumptions is the market value of the business constantly. So if necessary values of the company is can be used for the value in the other. So which asset based method, where the firm asset from the basis of the company evaluation. Asset based method is difficult to apply in the company. High level of intangible asset. Where is the problem? Intangible. Intangible mean, tangible mean the physical substance which we can touch, we can feel, we can say they have a physical asset, they have a physical value. So I'll give you example here. Bitcoin is all electronic coins. It's a trading online virtual money. So that's in the UK the government is banned to use the credit card to buy that thing, because the reason is in behind that virtual money is not secure against any other asset. Like in case of the currency, any notes, any currency, any money we have, behind the scene is the government have a reserve for them, for this money when they issue the notes. So in case if the note is not, and you can claim from the asset of the which is the reserve set by the central bank. But we shall look at the method trying to be intangible, is called goodwill value, which don't have a physical substance, so we call intangible. So that's we need to look around the tangible, intangible. Then next method is the cash based method, the free cash flow method. Here we're looking the sometimes, because in the business is a problem, lot of businesses they have a credit sale. So credit sale is maybe in future we not really get any money out of it. Like recently the Tesco manipulated the profit and put the credit sale more to show the people and attract the investor. They will come and buy their share. Actually the company profit was 280 million. The company manipulated the profit to 220 million. So 40 million worth of the profit being added as a fake figure. So we need to look around. That's not really, that's why it's quite good to be look around the cash, how much the cash really. Free cash flow can be find the value of the firm. The value can be used to determine the price in the merger and the acquisition, identify the share price for the sale of a block of shares, and calculate the share holder value added for the by management one period to another period. What's happened? The shareholder values increase or decrease by looking the market value of the share. You're looking the how much the cash being generated, not is it just based on the value, because we need to look around the cash as well. If you don't have a cash, is the lifeblood in any business. Anybody, any question, guys? So calculating the value technically, in order for the value of the business to be accurately determined, free cash flow for all the future years should be estimated. However, rather than attempting to protect free cash flow for every year and practice a shortcut method, so future cash are derived from the two time periods. They occur during the planning horizon, and then we looking they occur after planning horizon. So we were looking both. So this is a bit, slide will demonstrate the value of the firm using the free. We can use the value of forecast future free cash flow during the planning horizon, and discounted free cash flow. We discounted the money we'll get in future. What will be the real value of the money? The pound you have today, the money you have is a more value the money you will get in future. So beyond the planning horizons, we need to look around the terminate value, the value carry on decreasing, and find the PV, the present value of the future money which we'll get. At the short-term investment, value of the firm, less value of debt, and the value of equity. Active is called equity financing, which you mean the shares. Anybody, any question? Okay, so next we're looking the planning horizon. In competitive industries, business may have a period of competitive advantage. What is meant by competitive advantage? The advantage you have against the competitor. You're selling lower price, you have an innovative product, your location where you're selling, your brand image, your quality of the product, your uniqueness of the product, all this is come under these will lead to competitive advantage that you have, like the UK and various other developed countries. Their quality is mile better than the Chinese product. The reason is that's why the people trust on them. They have a competitive advantage. So knowledge-based economy, the economy those being set up through knowledge, to developing the human capitals, to developing the skills of the nation. So with that is create the value for organization, and that can be a competitive advantage against other organizations. So cost of capital, we need to look around when we borrowing money, what will be cost of loan and equity. The planning horizon, where the last of 10 years or more, is the period during the return are expected higher than the cost of finance. In period beyond the planning is assumed there is return will be continuous after a current rate reminder investor time around horizon. So must we need to measure within 10 or more than 10 years. That's normally. Okay, this is the equation we use to be calculate the cash flow statement and prepare the cash flow. So net operating profit, which statement shows, anyone? Net operating profit shows in the statement of comprehensive income. Then we add, let's say, interest and tax on it, less taxation, add depreciation back. We can find operating cash flow, less investment replacement. So all we can find, this is the free cash flow. How much is the cash being flow within the business? Inflow and outflow. Inflow mean the money in, and outflow mean the money went out of the business. So free cash flow can be calculated by taking the free cash flow calculated above and deducted the debt interest paid, deducting the debt repayment, adding any cash raised from the debt issues. In the practical term, free cash flow to the equity determine the dividend capacity of a firm, and amount can be afford to pay out dividend. Okay. So next we're looking at the method is called and the approach is called economics value. What economics value we are adding? Valuation method is developed by a firm called Stewart. It's combined the logic NPV model is a net present value method model and the use of accounting data to produce the firm. The estimated the economics profit, the amount by which earning exceeds the minimum rate of return and the investor could get from other securities comparable risk. So this we can use this model and that will help So EVA, economics value added. So we need to look around either really we added the value. So weighted average cost of capital, we can use this model, and we can net operating profit after tax we can calculate by using the equation. So that model is also help us to measure the value of the organization. Okay, anybody any question up to now? Okay, forecasting growth in the free cash flow. We need to look around historical estimate. We need to analyze and what will be the forecast for future and fundamental analysis formula. Gordon growth approximation. G growth is equal to R, and X, R is the uh, is normally the rate of return on equity, and the cost of equity, and B is the earning retention rate. Formula is based on the exemption, if this is happen then, and the reinvestment earnings. So this can be used to measure the value of the firm, that we are growing or not. Overall, what is the value we have now when we'll make the decision about the future investment as well. The next model is quite popular, which we use in to measure the strategic impact on the organization, is called dividend evaluation model. So theory of value of company and shares is present value is expected future dividend discounted the shareholder required rate of return. So exemption, the constant growth rate, we looking the P. P is the basic price. D is the dividend in the base year. 1 plus G is the growth rate. K is the cost of. K represent the cost, E represent the equity, and minus G is the growth. So this model we can use to measure the growth and the worth of the company. That is quite useful to look around the value of the company, because this will help as a organizations, because is normally the dividend. What is meant by dividend? Anybody knows what is meant by dividend? Okay, dividend mean the return. Dividend means return. So return on investment, or we call on shares, because investment in shares. So the return you're not getting as an interest, you're getting as a dividend. So the shares can be two types. Couple of you already knows very well. Ordinary shares. On older of these shares, they have a voting right. Second, we call the preference shares. So preference shares don't have a voting right shareholders, but they only get the fixed return on their investment. So that method we can look around to evaluation purposes as well. Next is called the market-based method. So market-based method is quite popular, is becoming more popular. The stock market value, market capitalization for listed company, the stock market value of the shares or the market capitalization is the starting point valuation process. In perfect efficient market price of the shares would be fair at all times and would accurately reflect all the information about companies, realities. Shares price in tend to be reflect the publicly available information. So share price is suitable when the purchasing minority stake. Minority stake mean in the company, however the premium usually has to be paid above the current market price, and is called in order to acquire the controlling interest. Controlling interest, what we are requiring. Anybody knows what is the parent company, subsidiary company? Parent is means fully control. Subsidiary is means owned by parent. If we are owning shares between if we are earning 50% or greater, so we call subsidiary. If we own 20 to 49% shares of other company, we called associate company. So that's associate. And if we have less than 20% shares, so we call investment. We not called is a company, we is associate or subsidiary. Okay, that is help so we can will evaluate as well. So how many they have as subsidiaries. Okay, next always we is good to be look around the PE method. where we're looking the price earning ratios. So what is the price of the shares and how much is the earning we are generating through shares. And this model, of course, like other model, have some advantages, some disadvantages. So pro and cons we can discuss, in our assignments as well. Okay, anybody any question up to now? So guys, if any question, please carry on asking me. So that's P ratio method we can use as well. So this method is the key thing is we can look the business risk in the same industry. We look the finance risk as approximately the same level of gearing. Gearing mean, anybody knows the gearing ratio is mean debt to equity ratio. Higher the gear, if you drive your car in a high gear, there will be higher risk. Okay, so we really want, the balance between the debt and equity financing and to be value the firms in a balanced manner, because otherwise normally debt is cheaper than equity, but 60% debt and 40% equity. But if you are more than that, of course, it create a problem. So when equity mean if you issue more share, you lose the control, because the shareholders have a right to change your management influence. So we need to look around, we need a good balance about it. Okay, weakness of this is appear the accounting earning, which is more subjective. Then it's a more subjective really, which all based on uh, estimates. So we can say that's all we need to look around. Okay, next we're looking earning yield approach is simply inverse of PE. So earning yield is EPS is earning per shares and price per share divided by, and the value per share we can, and the earning yield. So different formulas we can use, but these equation we can explain in our assignment as well. Anybody any question? Market book value, what is the value of the market? So that's why is always we need to look around what is the face value of the share and what is the market value of the share. So because always is a different value. So if I'm selling more than the face value of the shares mean I'm getting the premium. So asset based model, we look at asset of the companies and we then net realizable value, what is the value of asset, economic value, all we are following these. This standard this method we can use to value the firms as well in a strategic level, short term, medium term, and the long term perspective. So I'm not going through in detail, but I'll help you as well, and we can discuss in assignment. Intangible asset valuation method. Intangible, as I earlier mentioned, intangible mean don't have physical substance. So that method we can use to measure value of the firm, measure the value of the business, and when we make acquisition and purchase, so we can look around tangible asset. Then next approach is given by Porter, is called strategy clock. Strategy clock identify the strategy that might lead to the competitive advantage. Look at the market facing generic strategy. Porter generic strategy, couple you learn. We can be cost leadership. Think about Ryanair and EasyJet. Ryanair especially is a cost leader in the market. They're offering cheaper. So everything your focus, you want to be cost leader in the market. You want to provide the cheapest goods. But that's why you need to be regular, look around all possible options to reduce the costs. So that's because the cost leadership approach. Then second can be differentiation. You want to be differentiation. So you want every product different than your competitors. So that's a differentiation strategy. Then can be focus. Differentiation mean you narrowly differentiate because we are similar. We are selling airline, all the airlines similar. Maybe you can one element you can book ticket online. Maybe you have a swimming pool within the flight. That's a focus differentiation. Yes, one area you can, or one product you can, or one package you can. So strategy that will be, so these are according to the clock. We need to look around all the strategies, the price high or low, we need to perceive the product and services benefit is a high or low. So high, we can look around first no frills, low price, hybrid, differentiation, focus, strategies that will fails, and strategies that will fails, and we look around the strategy that will fail. So all this is a clock. We can look and we can show all possible option, all possible strategies, what cost us. It will be high cost or low cost. So that's according to the pricing strategy. Routes 1 and 2 are the price-based strategy, route 1 and 2. Route 1 and 2, no frill, low price. So these are the price-based strategies. No frill, quantity like product and services, very price sensitive customer. Simple product and services are innovative, is quickly initiated, and price is the key competitive weapon, and the cost kept lower between the product and services. Second, low price aims to low price without sacrificing the perceived quality or benefit. In the long run, low price strategy is supported by the low cost base. Hybrid strategy achieves the differentiation but also keep the price down. So high volume, some other ways in the cost can be kept low, like in China making in trillions productions. So differentiation strategy, route 4 and 5, differentiation, offering better product and services, higher selling price. Product and services need to be targeted carefully. Customer going are willing to pay the premium price. Focus differentiation, offering high perceived benefit at high price. So all we can look around in this focus differentiation. Then 6, 7, and 8, failure strategies, ordinary product and the services being sold at a high price can only work if the protected monopoly means the one company is offering some organization. Option 8, by sneaking reducing benefit while maintaining the price. So we can look around these all the routes to be fine. TQM, which other we can look around strategically, we can total quality management. So everything will focus on the quality. Differentiation through knowledge management. Knowledge management involve the uncovering or discovering knowledge, capturing knowledge, sharing, distributing knowledge, leveraging knowledge. Knowledge management has been is we can look around. So knowledge is carry and maintain the competitive advantage through knowledge. So the knowledge you have, Apple maybe don't have other company. So if they carry on doing and investing and innovating product, carry on launching. So that's the knowledge about health, knowledge about the production, knowledge about environment. So different knowledge, and we need to be managed. Hyper competition can be very high competition, hyper competition, and under hyper competition, what strategies we can respond to this strategy clock. We can look around here. Differentiator could cut the price and completion successfully. All this we can focus in. Okay. So next, sustainable competitive advantage. We can look around sustainable competitive advantage. The advantage we have now against our competitor is very difficult. You carry on sustain. Think few years back, Nokia was the leader, but not anymore. What's happened? The Nokia is gone. It's the one bad C and one bad strategies lead to. So the CEO of the company tried to cut the research and development costs, saving and more, making that profit more, but in the long run it has impact. So we need to look around the short term, medium term, and long term any decision. So sustainable value of the strategic capabilities. Capability mean ability to do something. Yes, so must be one those the value for the customer. This capability not enough. Strategic capability is able to generate the customer value. So if we have a variety of the strategic capability, competitive advantage will not 10 if the competitors are identical, strategically capable, unique or rare resources of competencies are needed to allow the organization to outperform its revival. So robustness, strategic capability, the capability of should be robust. So meaning the hard to be immediate other for them, and their competitive advantage is not so often sustained through the physical or the tangible resources. So that's we need to look around this all three approaches to be sustained advantages which we can as the organization. So these are the so today lesson we learn about how we can create the competitive advantage, what strategies are best, how we can measure the organization value, how we can increase the uh, value as an organization. So how we can evaluate the value in term of the cash, in term of the sustainable competitive advantage. So different strategies we can, and strategy mean action plan. Anybody any questions? So today guys we learned this. If you have any question, please drop me email, I'll get back to you, and next lesson I'll go through with you. Today lesson is we discuss about learning outcome 3 and 4, and the next lesson will go through our LO5 6. If you have any question, so drop me email, please start typing your work and go through. So next lesson will go through LO5 and LO6. We'll go through the loan, different sources of finance, and we'll discuss about LO6, what is the weighted average cost, and then last lesson we'll go through investment appraisal. So if any question, anything, please drop me email. I'll get back to you as soon as possible. Okay, have a wonderful time all, and I'll speak to you next week. Thank you. Bye bye.